Hey, it's Dr. Gold again. So we're up to chapter 3 here, which begins to get into the financial statements. I'm going to break this series of videos up into basically three shorter videos, one covering the income statement, one covering the balance sheet, and the third one covering the statement of cash flows. So let's just get started here so we can just sort of see what this stuff is all about. All right, well, to begin with, the financial statements here that we're going to be talking about, which again include these four different elements, you should know are created for a number of reasons. You'll learn a lot about this, or maybe you already have, if you've taken financial accounting. If you haven't, this will give you a good heads up into things you need to know for that class. I'm by no means an accounting expert. My background is in finance and entrepreneurship. So while I know a decent amount about the financial statements, I would never claim to be an expert. So here we've got the income statement number one and the balance sheet, statement of cash flow, and statement of shareholders' equity. These documents are essentially produced for two primary reasons. Number one is to allow the company to track and compare its own progress over time. And number two, for public reporting purposes, to provide outsiders, whether they be investors, private or stock market investors, with information about how the company is performing financially. When you take a managerial accounting, which is a different course and a different topic, you'll learn that managerial accounting is all about internal accountability standards, and that's a really important class as well. But for our purposes, we're going to focus on the external financial statements because when doing analysis of stocks and trying to figure out if certain assets are undervalued or overvalued, the information that we rely upon oftentimes emanates from these documents. So what is an income statement? It is sort of a reflection back in time. Could be a 1 month income statement. Sometimes it's referred to, you should know, as a profit and loss statement. Could be a 6 month, 1 year income statement. And basically what it does is it looks back over time at three broad categories. One is your sales or revenues. Then you deduct from that your expenses, and then what's left over are your profits. Sometimes you don't have profits, so you have a loss for that particular year or period. It's a very important document to look at because it allows you to know if things are tracking in a positive direction or negative direction, but without really looking at similar documents for competitors of companies within the same industry, and without looking at other financial statements and analyzing them, it's hard to really say if a particular financial document is strong or weak. A balance sheet, unlike an income statement, is a snapshot in time at one particular moment. As of X date, these are the assets that the company has. These are the liabilities that the company has, and what's really left over is the shareholder equity. You should know that the formula that accountants often will use, and one you'll learn in financial accounting, is that assets equals liabilities plus shareholders equity. So you might want to write that one down. Assets equals liabilities plus shareholders equity. And when you think about it intuitively, all businesses have assets of some sort, things that have value, whether it's machinery, equipment, real estate, patents, whatever the case might be, they have these assets. But the question is, how did they pay for those assets? How did they get the money to acquire them or generate them? And there's really only one of two ways, or a combination of both, which is either to borrow money, which are liabilities. debts that you owe, bank loans, issuing bonds, and so forth, or getting people to invest in the business, which is shareholders' equity. That's the only way you can pay for stuff when you have a business. You can either put your own money in if you're an entrepreneur just starting out. Your friends and family might put money in, or you can use your credit card and try to start up a business that way, which would be liabilities. But that's it. You can either borrow money or get investors. So that's sort of how the financial formula functions. Again, assets equals liabilities plus shareholders' equity. A cash flow statement, it sounds and looks somewhat similar to an income statement, but it's not, because it only reflects cash that's flowing into a company and out of a company. And why that's important is because there's a big distinction between profit and cash. Okay, profit and cash are not the same thing. They sound similar, but they're not. Company A, for example, let's say finishes out their fiscal year and they have a profit of $100. How could it be the next day that they can't pay any of their bills, yet they had a $100 profit the night before? Other than someone stealing the money and so on and so forth, the answer is because the revenues that were reflected at the top of the income statement, which we'll see in a moment, were revenues that have not yet been collected. Oftentimes companies will sell products and services to customers, and those customers will not be responsible for paying for those products or services for a period of time. So you might say, hey, I want to buy a table from you, Dr. Gold. And I'll say, fine, I'll send you the table, I'll build it and ship it to you. It's $100 and you don't have to pay me for 3 months. This way it gives you time to use the table and make money off of the table, so you can then pay me back for the cost of the table. So I sort of indirectly finance your ability to use the table. But I can report that sale on my income statement as revenue. Even though I don't yet have the $100 from you, I can put it up there and say, well, it's coming in 60 days or 30 days. On a cash flow statement, you can't do that. You can only report cash coming in and cash going out of a business. And it's really the lifeblood of every business. And I think it is the most important financial statement out of the three major statements. Cash, especially for smaller companies and startup businesses, is critical, but it's also very, very important for larger enterprises as well. We'll get back to the shareholders' equity part in a separate video. All right, so let's take a closer look here at the income statement. I'm just going to kind of skip to one that's in the textbook so you can kind of get a sense of what they look like. Here you see at the top it says sales or revenues of $2 million or $2,700. We know that's in millions though, because it says up on the top here expressed in millions. That's $2.7 million. Then they have this thing called cost of goods sold. Now, not all businesses have that, but costs of goods sold are the costs the business had to incur to generate $2.7 million in this particular case. Now, those costs might include raw materials that go into making the product that generates those sales. Costs of goods sold might also include the labor that was incurred to build the product that generates the $2.7 million in sales. But you have to factor in the costs of goods sold, especially in a manufacturing business, because you can't really tell what your profit is if you don't know what your costs are. So service businesses, like banking and consulting businesses, restaurants, tend to have a lower or smaller costs of goods sold, but it can really vary from business to business. When you deduct the costs of goods sold from the revenues, you're left with $675,000. That's referred to as your gross profit. One of the calculations you'll be doing is to figure out what the gross profit margin is of the business. I'm just going to minimize this screen for a second and bring up my calculator. Gross profit margin is calculated by taking the gross profits of the business, which in this case is 675, and dividing it into the revenues of, in this case, it'll be 2,700. So in this case, this company has a gross profit margin of 25%. I always ask my students in the classes that I teach on ground, is a 25% gross profit margin good or bad? And some students say it's good and some say it's bad, and we have a little bit of a discussion about that. But the answer is you can't really say if it's good or bad, because we don't know if it's good or bad unless we compare this company, here it's called Boswell Incorporated, with a competitor. Because if Boswell Incorporated has a 25% gross profit margin and its competitors, or the industry average for their industry, are gross profit margins of 55%, well, that's a horrible gross profit margin, 25%. On the other hand, if they have a gross profit margin of 25% and the industry average is 18%, well, that's a really good gross profit margin. So in accounting and in finance, isolated data like a company's gross profit margin is relatively useless information, except for comparison purposes against previous periods of time. And also, unless we compare it with other companies and say, well, their gross profit margin is X and ours is Y. So you have to be careful with these numbers as you progress through this semester and through the different activities. After your gross profit are your operating expenses. So this is going to include rent and utilities and salaries to executives and a whole host of different things. In this case, this company's total operating expenses equals $292,500. Again, that gets subtracted from the gross profit, and that leaves you with a net operating profit of $382,500. You can also do the same calculation for net profit margin by taking 382.5 and dividing it into 2,700 to find out what the company's operating profit margin is. This is also referred to as EBIT, which stands for earnings before interest and taxes. EBIT is the same thing as operating profit. It's earnings before interest and taxes. You'll see underneath of that something called interest expense. Companies can deduct the interest that they pay on debts that they have before they have to actually pay taxes. So there you see interest expenses of 67.5. So that's deducted from the operating profit of 382.5. You see that here. And that leaves us with earnings before taxes of 315, and their taxes are $110.25. Again, if we wanted to figure out what their tax rate was, we could take the dollar amount they paid in taxes, divide it into the earnings before taxes. It looks to me like it's approximately 30% or so. Then they have a net income, which is the earnings before taxes minus your income taxes. And net income is considered to be the bottom line in a profit and loss or income statement. It's the bottom line within that. Now, what can a company do with net income? Well, they can do one of two things. They can either reinvest that money into the business, or they can pay dividends with net income. Or a combination of both. They can pay dividends and reinvest the money. If they if they take the money and they pay dividends, whatever is left is called retained earnings, and that gets transferred onto the balance sheet, which we'll look at in the next video. The last thing here is earnings per share. And earnings per share, you simply would take the net income, you'll see this on the next slide, and you divide it by the number of shares outstanding. So earnings per share will equal net income divided by the number of shares outstanding. So that's it for the income statement. We'll pick up with the balance sheet in the next video.